Australia's housing market might start to slow to around 4% this year. Now, that's according to the Global Housing and Mortgage Outlook report.
It still lists Australian homes as the third most expensive of 22 countries surveyed. Here with us now is Ben Kingsley, the Chief Executive of Empower Wealth from Melbourne. Ben, good morning.
Good morning.
What is your take on the property market for 2015 in Australia?
Yeah, Eliza, what we've got to realise is the property market in Australia is made up of sub-markets. I mean, it's such a large population base where we're growing, the population's growing, the economy's softening, but we've got to look at different markets. They're in different cycles. So when we look at Sydney, we do believe that the pace of growth is going to slow. So there will be some more growth in that particular market. But what we're actually seeing is really good signs around planning approvals. Those planning approvals are going to mean that there's going to be more stock that comes on the market. So from a supply and demand point of view, we're going to see that supply kick in. And then from the demand side, we're actually seeing immigration slowing. So population growth slowing. So we believe that combined with potentially a slowing general economy is going to soften the demand for property, and we'll see those prices start to slow down, certainly in Melbourne and Sydney. On the other side of it, we've got Brisbane, which is a marketplace that's still in its upward cycle. So we suspect to see Brisbane actually doing quite well in 2015.
Now, you talk about the supply side of things, and in your city, in Melbourne, I think it's well known that apartment buildings are popping up every second day, it seems, particularly because of those investors from both overseas and locally. Now, will we see the price drop as a result of this supply? I mean, you say that it will tend towards that, but we have seen prices go up in spite of these buildings popping up.
Yeah, but it's early days. I mean, we're talking about upwards of 200,000 planning approvals. Now, we've never seen those sorts of numbers. So what usually happens in these types of cycles in Melbourne, Sydney and Brisbane alike is that we start to see confidence around building because we're seeing sentiment around property being quite strong. We're seeing investors come into the market. So there's this lag effect where these buildings take place in sort of late 2015 and they become occupied in 2016. So that's why we see with low interest rates at the moment, we're actually going to see prices continue to grow, but I suspect some of that gain will be given back in 2016 when interest rates start to rise.
Okay, so let's look at it from both the perspective of sellers and buyers. I suppose first the buyers. If you're out in this market, how should you approach it?
Look very cautiously in 2015. We don't want to have a herd mentality and think we're going to miss out, so we pay a premium to get into our property, whether we're buying for owner-occupied purposes or even for investment purposes. There is going to be certainly, a big supply of units that's going to come onto the market, but it's certainly those inner city areas around, sort of fully developed areas where housing stock is at a shortage. There'll still be really strong demand in those areas. So be sensible from an owner-occupied point of view. Take a long-term view. Say to yourself that this is something that we need to afford today, but also afford tomorrow. And certainly when we're talking about greenfields and new estates, there's certainly an excitement out in that particular marketplace. So we want to say to people, be cautious out there, do your research, make sure that you understand the supply that is coming on, because if there's going to be an oversupply, then technically we're going to see flat values in those marketplaces in 2016 and 17.
Now, Ben Kingsley, you mentioned interest rates there, and as we know, 3 of the 4 major banks are predicting that the current record low cash rate of 2.5% is probably going to go down even further. Won't that mean a rise in prices as more people get into the market, as more people take on mortgages?
It's a great question, Oscar, and I think that the important point here is that's not necessarily going to be the case, because what the Finch ratings report also talked about was what we call an affordability ceiling, and that's a measure of household incomes with the ability to be able to borrow. So if the cash rate actually comes down and interest rates goes lower, the lenders aren't actually adjusting their assessment rates, which means that borrowers can't borrow more. So we're actually going to hit an affordability ceiling, which means that it won't necessarily put pressure on house prices. But in saying that, APRA and the board have got a real responsibility in making sure that we don't see the pricing of prices go too far, because that could be into a bubble realm, and we don't want that at all.
On the bubble point, are there pockets, I mean, we see particularly in Sydney that, the market is really coming back very strongly. Are you at all concerned about that?
Not yet. I don't think we're at that stage. I think if we measure, the banks do stress testings on their mortgage books all the time, and we've arrears rates are around 1.5% at historical low levels. So I don't see any challenges there. But I certainly wouldn't want to see double-digit growth in the Sydney market in 2015. I suspect we're going to see that single-digit growth rate, and I think we'll see that in Melbourne. I do suspect double growth rates in Brisbane, and I suspect also Adelaide's going to have an interesting time, and Perth, unfortunately, with the mining boom, it's probably going to be stagnant, and Canberra's also going to be another market that I think is going to be quite soft.
OK, Ben Kingsley, we'll have to leave it there, but thank you again for your insights.
Thank you very much.